and get going. So as all of you know, in the past couple weeks, all eyes have been on the stock market. We've seen GameStop rise from $18 at the beginning of the year to an astronomical $438 per share. The rise was led largely by retail investors on Reddit, and hedge funds have lost about $20 billion in the process. And even though the GameStop shares have come down a bit, the GameStop saga is still on everyone's minds. If you got a chance to watch the Super Bowl, there was a commercial for both Reddit, where it mentioned the Wall Street Bets subreddit, and also a Robinhood commercial, because they've been in a bit of hot water lately. So I'm incredibly fortunate today to be joined by Joe Grundfest, a former commissioner of the SEC and the co-director of the Rock Center for Corporate Governance, and Darrell Duffie, a capital markets expert and a distinguished professor of management and finance at the business school. Thank you so much for being here with us.
Thanks, Anthony.
Pleasure.
And I wanted to go ahead and start by asking you a general question, which was, what exactly happened last week? Like, why are there movie deals currently being written about the GameStop spectacle? Why is this so significant, and why is it a financial history?
Joe, you go ahead.
Well, you know, one simple answer is there's money to be made here. This is a terrific story. There really isn't very much precedent. It hits on so many different contemporary social scenes. You know, here what we have is arguably the small guy sticking it to the man. All right, you know, a great story of the people gathering together and doing something that's never been done before. It's got the social media context in terms of people, you know, massing online in a way that physically would have been impossible to do at any point in the future. You're clearly going to have a bunch of individual interest stories. There are people who've made fortunes and people who've lost their entire life savings. And you're going to be able to get people to buy a Netflix subscription because they're going to be watching all of this stuff. It's, from that perspective, it's not a mystery.
And Joe, in addition to all the tentacles that you mentioned, there's the legal issues. Who's going to get sued? There's the
Yeah, but nobody's going to pay to watch that. I mean,
regulatory issues. What are the regulators going to do? They're all meeting in Washington. And then there's the market structure issue. What are the broker dealers, the securities clearing corporation, and the pay for order flow dealers? What are they all going to do about this?
You know, Darrell's absolutely right that there's a certain sense in which this is a virtually unique situation. It simultaneously implicates some of the most difficult market structure issues, securities enforcement issues, and the kind of thing that you can turn into a musical on Broadway. I mean, very few things stand human interest at.
And I'm curious, have the two of you seen anything like this before?
I was completely flummoxed when it first happened. It didn't occur to me that a whole lot of small investors would gang up on a small number of big investors. Usually we think about it the other way around. And life has changed. We're in an age in which that's possible, and in which people are also kind of riled up, and as we've seen in the political world as well. So it took me by surprise. Joe?
The closest I've come, it's a little bit like one of my hypothetical law school exams come to life. There's a Supreme Court opinion called, Santa Fe versus Green, which raises the question of whether you can actually have a fully disclosed manipulation. And, I would provoke the students on the exam by giving an example of a manipulation. I'd try to make it as fully disclosed and honest as possible, try to have it work. And the students always come back and say, no, it can't work for this reason, that reason, the other reason. Terrific exam answers. But what we see with GameStop is something that's pretty close to an exam, a law school exam hypothetical actually come to life. I never thought I would see it.
And so, Joe, you used to be a commissioner at the SEC.
Yes, but I'm better now. Thank you.
You're better now. You're better now.
Yes.
But I just want you to take us, what would be going on? What would you be doing right after you heard this news? So what type of investigations would you be looking into, and what do you think the probability is of success?
Well, number one, you immediately go into crisis mode. The agency has experience going into crisis mode, and I hope it hasn't lost that experience. Number one, you would want to start by gathering as many facts as you can. You have to be on top of the facts. And in many of these situations, it's much easier to be gathering the facts real time than to go back in time and attempt to reconstruct history. You would number one, immediately start thinking about how is it that any of this might be a violation of the federal securities laws? Which specific provisions would be violated? Are we talking about a 10b-5, a 9a2? It gets really complicated. What would we have to prove? How would we be able to prove it? As a practical matter, the thing the SEC can most easily prosecute is fraud. Now, there are many people that have talked about this. Matt Levine writes about it as an honest pump and dump. Here's the problem. You could, in theory, on a law school exam, have a situation where everything that's said on a subreddit is entirely honest and truthful. But in reality, what's the probability of that? If you got hundreds of thousands of posts coming in, what's the probability that everybody is telling the truth when they're posting? And we know that a whole bunch of these posts are bots. Well, here's an interesting question under the federal securities laws. If you're a bot that's posting and you're trying to appear like a human being, well, isn't that fraud, right? Isn't that a violation of the federal securities laws? So, what do we do? Do we take all of these bots and throw them in bot jail? No. You got to find out who is it that's behind the bot. How do you do that? And when you find out it's some teenager in Latvia, all right, what's the SEC going to do about that? So you've got all of the traditional enforcement mechanisms. We're going to look for fraud. Interesting question. How will you find it? How will you be able to prove it? And what will you be able to do when you find the people responsible for it? And then you've got much broader policy issues. What do we do about the short selling, right, that occurred over here? What are the broader market structure issues that are implicated by all of this? Do we need to change any of our rules in terms of posting of collateral and margins and T+2 settlements and borrowing for short sales? And, with all of those issues, let me shift it over to Darrell, who's one of the world's leading experts on these questions.
Well, Joe, you're the expert, but on top of all the things that you mentioned, one of the first things that I would do is look into what additional sources of financial instability here have yet to land on markets. So for example, there's a financial institution whose job it is to guarantee the settlement of all US exchange traded equities. Do they have enough funds to do that? This is the National Securities Clearing Corporation. They have to lurch back to the market and ask for a bunch more. Do the broker dealers, are they stable? Are there going to be cascading effects here? What about the hedge funds that lost a lot of money? Are they going to implode, and will that have cascading effects? So right away, I think looking at those before going to the longer term market structure issues would be one of the first things that I would do.
Yeah, so I think what Darrell is saying is that one of the first things the SEC would also do, in addition to looking for fraud, is just checking to make sure there aren't any leaks in the plumbing that stands behind our financial system. And what's really intriguing is it's an extraordinarily complicated plumbing system. And let's just be polite and say it's not state of the art. That if we had to invent a plumbing system today, it wouldn't look at all like the one that we have. And again, politely put, there's a lot of legacy software that's built into this system.
Well, I guess, so I want to go back to something you mentioned, Joe, at the beginning, talking about the bots. There's this sense that this may happen again, that this was the first time that kind of Redditors banded together, but they could theoretically do this for another stock. Do you think that's likely? Do you think that either market forces or regulatory action will make it less likely in the future? Love to hear your thoughts on that.
Well, just a simple rule of thumb, the probability that something has happened once will happen again is probably higher than the probability that something that's never happened will happen for the first time. Now, mathematically, you can't prove that because it's an infinite set of things that have never happened. But I think you understand the intuition. I mean, people now know that we can put together a ragtag army, all right, on Reddit and try to attack a relatively small cap, highly shorted security. And I'm positive there are a bunch of very, very, very smart people right now sitting out there going, all right, what else can we do?
Joe, I agree with you. This raises the likelihood that it could happen again. Now, especially now that the mob of retail investors that made it happen once have the sense that they can do it again. And we've already seen evidence that they've gone after other assets like silver and so on. But I think pushing the other way, there will be corrective forces in markets. People will come better prepared next time. So for example, firms like Robinhood, they'll get better capitalized ahead of this and they won't have to stop trading and upset a lot of their customers. And the National Securities Clearing Corporation may ask for more margin to make sure that they can safely settle these trades. And corporations whose stock prices get bid way up may say, wow, this is an opportunity for us. We can issue shares when the prices are so high. And if we're worried about being accused of selling at a very high price, we can do an end run on that. We can issue warrants at low prices that investors can exercise to buy shares when the prices get high enough. And we can make money that way. So all of these forces are going to tend to control the extent to which this just becomes so disruptive that it causes big upsets in the market. Like
I would add another, I think, potentially powerful disciplining force. And that is, many of the subreddits said, to the moon, we're going to take the price to the moon. Okay, I got a simple observation. You can go to the moon, but you can't live there. All right, you can push the stock price up to, what is it, $438 a share that was the peak. But guess where it didn't stay? $438 a share. It's come way down. And if we look at the trading process, and if we assume that the corporation doesn't sell any additional stock, and there are no insider sales, and it's a pure secondary market transaction, you can demonstrate, or at least Professor Duffie can demonstrate, that it's a zero-sum process. That all of the money that gets made on the way up has to be lost by people on the way down. So there are today literally thousands and thousands of small investors that have also lost some portion of their life savings because they got in at too high a price. And as the stock is running up, and as everybody is getting rich, all the small investors are getting rich on the way up, they're all, putting subreddits and taking photos of their accounts and showing how they've made thousands and thousands of dollars, and yay, the party's going on. But at some point, these things always peak, and then it comes down, and everybody's got egg on their face, and everybody's got red, all right, on their brokerage statements, and all of a sudden, they're not bragging so much. So the zero-sum nature of this secondary investment trading process may itself turn out to be an important self-disciplinary mechanism. All the money you make on the way up, you're going to lose on the way down. If you get in too late, you're a loser. It's like a Ponzi scheme. Thank you very much for playing. I'll take it.
Do you think there could potentially be the opposite effect, where the people who lost out on the GameStop rise are going to be eager for something to happen again? That way they can feel like, they're in the prior half to win back what they lost?
I mean, a lot of these people were not in it, they said at least, to make money. They were in it to, as Joe said, stick it to the man. And part of the enjoyment they got encouraged them to take part, even if they were taking too much risk. Now, a lot of people also just followed in and lost money without really understanding what they were doing. And that's the unfortunate part. Yeah. So while it's a zero-sum game in terms of dollars gained and dollars lost by these investors, it's not a zero-sum game in terms of where the US economy comes out of it. So I really think that we do need a better market structure to reduce the likelihood that this causes this kind of disruption in markets in the future. We had a close call this time in terms of what might have happened had firms gone under or financial market infrastructure not performed properly. But even so, even without having lost anything of that sort, there's less trust in markets than there was a few weeks ago. And I think addressing that would be really helpful. One of the things that I would like to see is a more efficient market for shorting. Now, I know a lot of people think, what? You want to make it easier to short? Surely you can't be joking. Shorting has a very bad reputation among many people. But I mean, as an economist, you don't want to make it harder to short than it is to buy if you want an efficient market. And there are things that can be done. Right now, the ability to short is very limited by an opaque market. The prices for shorting are not transparent, the cost of borrowing, the wait for borrowing, the time to settle. And that market structure really needs to be addressed. And that's one of the things that could be done.
Yeah, so I think Professor Duffie is absolutely right. But one of the most fascinating things that I've observed ever since I was a commissioner in 1985 is that there's a huge gap between the intelligentsia that I think is correctly arguing we've got to get rid of efficiencies in the short market, and the political world that basically hates shorts. And there's a real simple political explanation for that. And that is the world is net long equities, right? And the shorts that come in are basically raining on the net long parade. And for that reason, there will always be a political predisposition that can rationally be explained why Congress and regulators and the like are opposed to the shorts and don't want to make shorting easier, even though, as Darrell points out, and as a large body of the academic literature points out, making shorting easier creates more efficient and in many ways better markets. This is a gap between the politics and, between political reality and intelligentsia reality. And this is a gap that in many ways will never be bridged because it's not in the political reality's best interests to arbitrage in any way.
One of the good things about US financial markets as opposed to some foreign financial regulators is that the US is usually more reluctant to ban shorts. Now that didn't happen in this case, but there have been cases in the past when the short selling of equities was banned. In fact, I spoke to the House Financial Services Committee about why it would not be a good idea to do that in the United States. And so I think the regulators and politicians are interested in understanding the costs of banning short sales or making it difficult to short sell. And as Joe said, as you said, Joe, the evidence doesn't help the case for banning short sales. In fact, during the financial crisis when short sales were banned, the evidence shows that even the firms whose shares were placed on the ban list were worse off. That is, the prices were lower or as low as they would have been had they not been on the ban list. So, all the evidence is in favor, and I think we just need to keep, academics like you and me, Joe, we just need to keep helping people understand the cost benefit of that.
Yeah, but as I try to help people understand, I also recall Don Quixote. All right, and if we're actually going to try to make that change in the real world, Don Quixote has some lessons for all of us.
Well, never tilt at a windmill. But as I said, in the United States, I think Congress and the regulators have the idea that it isn't a good idea because it's rarely done here as opposed to in many other countries.
Let me rewind for a second, going back to an earlier question that Tony asked. Can this happen again? One of the things that's an interesting way to think about it from my perspective is to realize that we have a new generation of influencers. And people think of Instagram influencers as affecting, the clothing that you buy and the music that you listen to and the dances that you dance. Well, are we going to see the evolution of a new generation of Reddit influencers who have a comparative runs will systematically be able to profit from these runs, all right? And it's a little bit like a different version of a pump and dump, all right, where they're in early, they cause the run up, They're not in anywhere close to the top, and they wind up rinse and repeat. We're going to do this once, twice, three times, and they've got a comparative advantage in terms of knowing how to rile up the crowd and get them going in a direction that builds this cycle of people making money on the way up, and then of course it collapses because gravity has to.
Well, it's a free speech thing, right, Joe? I mean, everyone can say that. Well, what are the laws, if you know, about the extent to which they can pump and dump by the method you described and profit at the same time? Is there anything proscribing that?
Well, there are a couple of things. Number one, if the SEC can find fraud, all right, what they can then do is get an injunction, all right, against the individuals. Untested question. If they find a forum in which there's a substantial amount of fraud, could they go to a court and get that forum shut down because of the amount of fraud on it, even though there's also a significant amount of honest speech? More fundamentally, Section 12K of the 34 Act allows the SEC to shut down trading in securities for a wide variety of reasons, including if they think that the price is being influenced by fraudulent activity. So if the SEC wanted to, it could have shut down trading GameStop stock for 3-4 days. Right? It could do it for up to a month. Clearly, terrible adverse effects whenever you shut down trading in a stock. It's nothing that I'm recommending, but the question that Darrell asked is, what could the system do? Not what should the system do? Yes, the system can shut down trading whenever it thinks stocks are manipulated. It has collateral effects, but it's in the toolkit. You don't need new legislation to do that.
And I want to ask you, just turning a little bit to the company side, and specifically the public company side. What happens if you're GameStop, or if you're another one of these companies that's subject to this Reddit phenomena, and you see your stock climbing up? What do you do? What should the board of directors do?
Joe?
Well, it depends very much on the company. I can imagine some companies, what you do is you go, woohoo! You break out the champagne, you go, hallelujah, all right? Our stock, we really think is worth $10. People are willing to pay $100 for it. Let's go sell as much of this stuff to these people as we possibly can. Let's use our shelf registration statement to sell a whole bunch of equity. Let's make sure that we're not lying to anybody. Let's make sure that we explain that we have no idea why our stock is selling at $100. None of our financial models support the idea that it's worth $100. But if you'd like to pay $100 for it, please, right, here's the stock, give me your $100, have a nice day.
So Joe, just to make sure I get it, because I learned about 10b5 first from you, you're saying even if it's quote unquote common knowledge that the price is way above the fundamental and everybody's writing that across all the headlines, if you sell shares at that price, no one is going to successfully litigate you?
If there's no material misrepresentation or omission, if there's no material misrepresentation or omission, then there's no cause of action under 10b and 10b5. It's that simple. The statute prohibits lying, and if the crowd on Reddit pushes you up to $100 a share when you're worth 10, and if you tell people, look, here are our financials, there are no lies over here, all right? We don't think we're worth $100 a share. We have nothing to do, if it's true, with what's going on Reddit. That's none of our business. We can't explain it any better than you can, but it seems that people are willing to pay $100 a share. And if that's right, we're willing to sell our $10 stock for $100 a share for as long as people are willing to buy.
Very interesting.
And speaking to this phenomenon, how much do you think, on one side, it's really the power of social media, and it shows how people can get together to invest together in a stock. But there's also kind of another camp that perhaps this is very unique to the pandemic, because we have a record number of people at home who have time to keep their Robinhood app open all day. Perhaps some of the attendees today have Robinhood open right now. Maybe they put in a couple of investments, maybe in Dogecoin or something else. But do you see this carrying on after COVID as well, or could we possibly constrain this to the current time that we're living in?
I see it as continuing past COVID, because I think it's not as much COVID, although that contributed, as mobile finance. The fact that people can, with a swish on their mobile phone, trade stocks, and the younger generation coming up, that's how they do all their business. And I think it's going to be an entertainment. It's going to be, there's going to be a certain amount of gambling addiction in a small subset of people. And there's going to be a lot of risk taking by people that are not familiar with the risk and return trade-offs that everyone teaches. If you look today in China, it's almost a pastime for most investors in China, many people. And volatility in Chinese equities is very, very high. And there's often huge pump and dump or innocent, enormous increases in prices and drops in prices related to surges of retail investors that are just following in to an individual equity. So I think we're going to see a lot more of that going forward, and that's why we want to get our market structure well in order.
Yeah, I would agree with Darrell. Again, we've seen this once. I don't think there's a reason to believe that if we're coming out of COVID at any time soon, that alone will stop. I think enough people will be able to take the 30 seconds that it takes in order to participate here. It's not a deep, long time commitment. And to many people, as Darrell pointed out, this is in a certain sense a political statement and performance art manifest in the financial markets, all rolled up into one. This is what I call sentimental momentum. I call this sentimentum trading. And it's a new phenomenon that nobody's ever really thought of or modeled before.
I sure didn't. Joe, did you read, like I did, that the week of the GameStop event, the number of members of Robinhood's subscription list went from something like 4-point-some million to 8-point-some million?
It was a big bump. I don't know the exact numbers, but the total download of apps and the like, yes, very, very, very severe. No doubt.
So this has definitely been good for Robinhood, and I think that's, well, maybe, but this is a good transition to talk a little bit about Robinhood and some of the other brokers. I'd love to hear your thoughts on what exactly happens with Robinhood, if this is going to play out well for them in the end.
Well, let me try that one first. There's been a lot of conspiracy stories about it was Robinhood against the little guys, or it was the brokers that served Robinhood's needs for orders in cahoots with Robinhood against the little guys. I don't believe those stories. I think that the simplest story is probably the correct one, which is that Robinhood had to limit its customers' trading so that Robinhood could meet its own capital requirements, its regulatory requirements, and to protect its existing Robinhood customers. So it had to raise a lot of capital and borrow a lot of money, get new equity financing in a hurry to make sure that it could handle its customers' orders. And in the meantime, it had to slow them down. And it took a lot of blame for that. So I would say Robinhood didn't come out of this all that great. It upset a lot of customers and created a lot of conspiracy theories that have harmed its business. On the other hand, it's as I just mentioned, it's increased its subscription rolls enormously. So maybe from that point of view, it's benefited.
So, but I think that the story is much more complicated and more nuanced. As Darrell points out, the conspiracy theories that are out there are really, they're not only, I think, non-credible, they're totally illogical. Because if the hedge funds really wanted to shut down the trading, Robinhood would have been out of the market for more than one day, and they would not have provided the capital that actually allowed Robinhood to restart the trading. The simple, this is up there with space lasers. All right, the idea that Robinhood was conspiring in order to stop the trading while it was simultaneously raising the money in order to continue the trading.
I think Joe may have frozen in a very
let me fill in one
time.
point while Joe is always unfrozen. Joe, do you want to finish your thought now that you're unfrozen?
I'm sorry, that simply to try to explain the theory that way, the conspiracy theory that way, that you were in cahoots with the hedge funds, and then you raised all of this money from the hedge funds so that you could start the trading that the hedge funds wanted to stop. That makes absolutely no sense. All right, that's like a space laser theory. I mean, in and of itself, the theory of the conspiracy just is self-contradictory and false part. It just makes no sense. And then, Gillian Tett in the Financial Times had a very interesting piece, I think, over the weekend, where what she observed is that maybe the people that are going to make the most money out of this are the investors who provided the additional capital to Robinhood. And the opposite side of that coin is the organization that may at the end of the day lose the most money out of this may well be Robinhood. Let me tell the story. They had to raise a lot of money. They apparently raised about $2.5 billion, and they had to do it very quickly. And they raised the money from existing sources of capital and investors that they already knew well. And when you want to raise money very quickly, you typically have to give investors a good deal. And according to public reports, they raised this money by promising the investors that when they go public, they will go public at a valuation that's the lesser of $30 billion or 30% less than the IPO price. So basically, you're getting the equivalent of a ratchet, a floor, put protection, and the volatility of Robinhood stock, the value of that floor, that downside protection, is huge. Now, Professor Duffie, Darrell is one of the world's greatest experts on valuing options and the like, so I'm going to let Darrell speak to that. But this is a situation where, if under normal circumstances, Robinhood wanted to raise another $2.5 billion, it almost certainly would have been able to do it on much more favorable terms than the terms that it had to give the investors. So from that perspective, Robinhood dipped into its own pockets, gave up equity value in order to raise the capital that it needed in order to let its investors start trading as quickly as possible. And today, given the decline in value, all right, GameStop stock and the fact that there's less of that trading going on, Robinhood is almost certainly overcapitalized relative to what any financial model would predict. So it paid through the nose to gather more capital than it actually needed. And at the end of the process, if you're just doing the financial gains and the losses, Robinhood may actually be a victim of all of this trading. Opposite side of the ledger. Yes, they have more accounts. I don't know how to balance this.
Joe, I would add, I completely agree. And I would add that there are a couple of lessons here. One is that while Robinhood was undoubtedly meeting its regulatory capital requirements, the fact that it had to raise money so quickly suggests that maybe those capital requirements need to have another look, or that supervisory work by the Securities and Exchange Commission would be a good idea, looking at all of the broker-dealers that are involved in this kind of trading to make sure that they can handle surges of demand for trading. And the other lesson is more or less the one that you described, which is that all of the broker-dealers involved in this kind of work should have abundant capital and liquidity before these kinds of surges occur so that they don't have to go into the market on punitive terms, as you described.
Yeah, but as Darrell knows, all of these capital requirements are in a certain sense based on risk models. And then the interesting question is, to what probability, against what probability do you insure? And I'm not aware of any risk model prior to GameStop that would have predicted anything like GameStop. I mean, you're out what, 3, 4, 5 sigma, all right, before you come to something like this. What would your guess be, Darrell? How many sigmas out is this event?
Certainly, I don't know in terms of volume of flows, but in terms of the nature of the event, it was unheard of. But I would go back to whether the broker-dealer capital requirements are sufficient. I looked into that situation leading up to the US financial crisis of 2008 and 9, and it was definitely not sufficient. The regulatory capital requirements imposed by the SEC were lax, and they were laxly enforced. So I don't know how much the SEC has done since then, but I would say that now that we're in a new era and things have changed, market structure has changed, it's time to have a very careful look at that.
And when we have that careful look, the other thing I think that in many senses is even more fundamental is why are we at T+2? Why don't we go to immediate settlement? And that would eliminate a lot of this problem altogether. You can either try to address the symptoms of a disease or get rid of the disease. If we go to T+0, doesn't that solve everything?
Now, I made that case in private to an expert yesterday, and he gave me a mild reprimand saying, you don't get it. If you push people to settle very quickly, they're not going to have sufficient liquidity, and that's going to be a problem. My rejoinder was, we're in the 21st century. We need to figure out how to manage technologically faster settlement, because the idea that volatile assets will only get settled 2 days after the trade is just not smart. And if we think
Darrell,
about
I think what happened is we may have lost a piece of the audience because I think the normal, well-adjusted, healthy people don't understand T+2.
Okay, go ahead and explain that, and then I'll come back.
Okay, so I was going to ask you to explain it because you're the one.
Easy.
But I can do it too, but it just won't be as good.
Okay, well, I call Robinhood today. I order some equities, and 2 days from now, between me, Robinhood, and the clearing corporation that handles the final settlement, we have to get the money to the ultimate seller of those securities. And the mechanism by which that's done, the plumbing, is kind of complicated, but we have 2 days to do it. And in the meantime, a lot of things could happen to that price, and somebody along this food chain could go under. And so shortening that settlement cycle to not waiting 2 days before the cash is exchanged for the securities would be a good idea if we can get the technology up to date to do that. And there are emerging technologies that involve blockchain. And I'm not talking Bitcoin now, I'm talking improved technologies that are being developed on Wall Street for doing this sort of thing.
Yeah, no, Darrell's exactly right. Well, we moved the system from T+3 to T+2 several years ago. You know, people are thinking about moving it now to T+1. And this has nothing to do with GameStop. All right, this is something that people have been talking about doing for decades. All right, GameStop is only an example of why it's really important that we get this done. And you know, as is the case with just about everything, there are huge costs. There are significant systemic costs to moving to T+0. And there are players in the process that will benefit from T+0, and there are players that will be hurt. So even though, as Darrell says, I think society would be unambiguously better off if we just bit the bullet, paid the price, moved to T+0, there are people who've got every economic and financial incentive in the world to make that as hard as possible to do. And to make it, you know, let's go to T+1 before we go to T+0 and immediate settlement. My view very simply is let's bite the bullet. Let's go to same time settlement immediately. Let's not fool around with T+1. Let's figure out how to, you know, absorb all of the fixed costs, which are non-trivial. All of Wall Street has to change its back offices. I mean, that's really what's involved. And there'd be a massive coordination problem because, you know, if one brokerage doesn't do it in a way that conforms with everyone else's, then you lose that brokerage in the system and everybody's got to be integrated. So it's a little bit like taking the whole country. We're all driving on the right-hand side of the street and saying tomorrow morning we're all driving on the left-hand side of the street.
At a minimum, I think just looking into the feasibility, doing a cost benefit is worth it rather than just waiting.
And Joe, I wanted to ask you, y'all both touched on the fact that Robinhood seemed to do everything it could to raise the capital, but the SEC still did release a statement saying that it would be looking in to see whether Robinhood disadvantaged investors or otherwise unduly inhibited their ability to trade certain securities. Do you think anything is going to come out of this SEC investigation?
I think the SEC just has to release something. And if the facts are, you know, consistent with what's been disclosed, if Robinhood basically said, look, we needed to be in compliance with our capital requirements. And for that reason, we had to throttle back your ability to trade. And this clearly was a situation where none of us anticipated this volume or this volatility. So it was not a situation where we were at all irresponsible in terms of the amount of capital we had to conduct the business that we expected. Rather, this surprised everybody, and it did. I think the SEC would have an impossible time to say, oh no, we saw this coming. We knew that this GameStop thing was going to happen and your capital requirements would increase by this amount. I think that's preposterous. If all of that holds together, then what you find is a company that went out of its way to raise an unprecedented amount of capital in an unprecedentedly short period of time, paying a very, very high price so these small retail investors could come back into the market and lose all of their money in GameStop.
I agree with Joe. And as Joe started today by saying the first thing to do is gather the facts, I would say we need to know a lot more. I think that's what Janet Yellen said when she was asked, what are you doing? She said, the first thing we're going to do is to learn all the facts. So before jumping to conclusions, let's let the regulators have a chance to do that.
In a second, I want to get to some of the questions that many people in our audience have been asking. But before that, I want to ask both of you, what would you tell the retail investor who is currently investing on Robinhood, who is still frequenting Reddit to look for certain advice? What would you tell that person that's looking for the next big thing?
Come to Stanford Business School? No, obviously more understanding of risk and return is good, and beware. You can lose a lot of money investing in very, very volatile equities, and you shouldn't assume that because the prices have been going up that they're going to continue to go up.
Well, one simple point is don't take investment advice from strangers you don't know, who have a variety set of incentives that you can't interrogate on a blind site where you're getting investment advice from Angry Kitty 33. Really? Would you take medical advice from Angry Kitty 33? All right, would you take life advice from Angry Kitty 33? So why are you letting Angry Kitty 33 run your portfolio? I mean, really? So, from my perspective, if you look at it that way, the problem is not Robinhood. The problem is Angry Kitty 33, right? Who is Angry Kitty 33? Why are they saying this? And why in the world are you taking investment advice from somebody with the name Angry Kitty 33? They could come up with a better name than
that. That's some great advice. So I didn't hear diamond hands from either of you, which is to just hold on for as long as possible on some of these meme stocks. Well, I wanted to thank you, and I want to get to some of our questions from the audience that they've been asking throughout, and kind of leave the rest of the time for them. One person back on the hedge fund angle was asking, the fact that Robinhood temporarily stopped trading, perhaps that could just be enough for the hedge funds to regain their footing. So in a way, maybe their interests were still being playing out. Do you think there's any merit to that argument?
Joe, that was your point that...
Yeah, no, look, there's a simple response. Let's look at the data, all right? And let's look at what happened, all right, during the period of time when the trading was halted. The data will speak for itself, all right? But as a pragmatic matter, if you stop and if you just think about the conspiracy theory, it absolutely makes no sense. It's one of the most incoherent conspiracy theories that I've ever heard anyone articulate. I've heard lots of them.
Okay, that makes sense. And another question was, could you speak a little bit about naked shorting? There's been some question about that. exactly what does naked shorting mean, and what has been its effects going forward.
Joe, do you want to do this?
Oh, you're the short expert.
Okay.
It's not as good coming from me as
I'm not that short. So naked shorting means, oh, well, there's a rule against it. It means that you've promised to deliver shorts, securities to someone that you don't yet have, or you're not confident that you can locate. So you've basically, it's a rule against it. The Securities and Exchange Commission has a rule against that, and broker dealers are required to know where they can find the shares before they can be provided to someone that wants to short them. Joe, did you want to add anything to that?
Yeah, just to oversimplify greatly, when you short stock, what you do is you borrow stock that you don't own and you sell it. And what you're doing is counting on your ability to buy it back at a lower price to return it to its rightful owner. That's a simple explanation of a short. And again, to oversimplify, there are rules that basically say you actually have to borrow the stock, right? Or know where you're going to get the stock before you can actually wind up selling it. And a naked short is one where you don't have the stock, you haven't borrowed it, and you're selling it anyway.
Yeah. So naked shorting was the reason why there was more GameStop, I believe, shares being shorted than were actually on the market, or is that
correct? I can
correct?
explain that one. That one's, there's been some mysteries around that. And I saw the question in the chat, which says, do you believe that over 100% of GameStop stock was shorted? How is that possible? And the reason it's possible is that the same shares can be sold more than once. So here's the story. Joe wants to short. He borrows the shares from me. Then he sells them to you, Anthony. And then you lend the shares to the questioner, Nadia Brennan, and she sells them. And then somebody else buys them, and so on and so on. So the same shares can be sold and resold until more than 100% of the outstanding shares were sold short. And that's exactly what happened during the GameStop period. It happens in other markets much more frequently, like US Treasury markets.
Yeah, so this phenomenon of there being a short interest in excess of 100% of the underlying isn't rare. It blows people's minds, all right? And what I find is when I teach it to people, I have to give an example, all right? Where we say, look, imagine there are 100 shares, there's one share, but this one share gets bought and sold 1,000 times, all right? Then you have 99 shares that stay put, stay home, and you have one high velocity share that just winds up turning over and over and over again, and it winds up giving you a short position well in excess of the 100 shares issued and outstanding.
Anthony, I see another question in the chat about shorting I'd like to address because it goes with this question.
Yeah, of course.
And this is a question from Andrew Winden asking about the fact that it takes time to find the shares to short, and T+2 settlement, which Joe and I discussed earlier, gives people time to locate the shares. This goes back to the point also that I made about our securities lending market, which is the market for finding the shares to short. So there are broker dealers, prime brokers they're called, that intermediate that market. Let me explain how it goes. Joe is running the Stanford Endowment, suppose, and he has lots of equities, and Anthony wants to short. So he needs to find those equities that he can sell. I am a broker dealer, prime broker on Wall Street, and what I can do is I can go to Joe and I can say, Joe, I understand you have some shares you don't need. I'm going to borrow them from you and I'm going to lend them to Anthony. That's how that market works. I'm going to charge Anthony a big price. I'm going to give some of that back to Joe. That market is extremely inefficient. It's very hard for the lenders like Joe to see what the going price is. It's very hard for the borrowers like Anthony to see what the going price is. And it all has to flow through a small number of large prime brokers. If that market were opened up into an all-to-all exchange type of market, where all the buyers, all the borrowers, and all the lenders could meet each other in the same place, it wouldn't take so long to find the shares that would need to be found in order to meet the needs of of the market. And that T+2 problem would not be a problem. Many other concerns about what happened during the GameStop events would not have been a problem. During the GameStop event, in order for Anthony to borrow those shares, he had to pay about 10 times the normal premium in order to get GameStop, because everyone was trying to find those shares and the market was just not efficient enough at locating them and matching them to the borrowers.
So I think one prediction is, if we're going to move to immediate clearance and settlement, T+0, there would likely be a parallel evolution of the software plumbing market mechanisms around locating shares that are available to lend and short, because the demand for that would also increase. And that sort of explains just a high level of generality that moving to T+0 will also involve other changes in the financial infrastructure. It would be a very, very significant software job, right? Up with Y2K in terms of re-engineering the whole financial settlement and clearing process.
So, sorry, Joe, I missed one adjective because of a freeze on the screen. Did you say that it would be a difficult software job or a simple one?
Difficult.
Yeah, I agree. It's not going to be easy. This is going to take a significant amount of work, but I think it's worth looking into.
And there's another question that has to do with just how some retail investors are looking at the market now. We've seen this with some of Elon Musk's tweets about different parity cryptocurrencies, but people looking at stocks and looking at crypto and not thinking about necessarily the underlying value that stock has, but just the value that it has socially compared to other people on Reddit or other people that are out in the world. Do you see this as a problematic way to approach the market going forward? And could you see some problems that it has kind of down the line?
Well, I think we've just seen that problem with GameStop, and we're going to see more episodes of that now that people have gotten a taste for it. So I do foresee that that's going to be a problem.
Yeah, I'm with Darrell on this. I mean, it's going to come up, and it's going to come up in ways that I think will largely be unanticipated.
And do you think some of those ways could be through malicious actors, perhaps other countries infiltrating our forums and trying to push up or pull down certain securities?
I never thought of that either. I guess I'm way behind the curve on all the different motives that people might have to trade equities rather than to profit from taking some risk. So no, I hadn't thought of that.
So now I see an army of Iranian bots trying to take down the price of Aramco. I mean, sure, I guess in a certain sense, not only is anything possible, everything is possible.
And are hedge funds going to be more secretive going forward about what types of stocks they want to short because they're concerned about people kind of identifying their positions? And do we lose valuable market data when hedge funds decide to do that? Because there likely is some utility in a large institutional investor kind of signaling to the market that they think something's overvalued because of all of the analysis that they've done. And that's a potential change that I can see, but I'm also curious about your thoughts.
Yeah, we've already seen some hedge funds stop producing the list of short positions that they have, but the market still knows in aggregate how much of a given stock is shorted. And that might be enough on its own to incite the retail investors that want to stick it to the shorts. So that'll mitigate the problem for individual hedge funds, but it won't eliminate the problem. What do you think, Joe?
No, I agree entirely. It's very important to recognize that you still have the aggregate short information out there. The additional information really goes to, in a certain sense, the weakness of the hands. If you've got a large short and held by a relatively undercapitalized entity, it would take less pressure, in a certain sense, to create a short squeeze that would cause them to have to cover. So to the extent that individual funds are no longer disclosing that information, that's entirely rational. on their part. And as long as everybody's complying with the rules and regulations, that makes sense. And we should also explain that there are lots of people that want to have more disclosure of short positions. And to say, for example, that if you're required to have a long position more than 5%, we know that you have to file a 13D. And there are many people who say, well, if there's a short position in excess of 5%, you then also should file with the SEC, to which the counter argument is shorts and longs don't really mean the same thing, because you can't exercise any control over the entity simply because you've got a short. And the reason for having the 13D disclosure requirement is to explain who's controlling the corporation primarily. And that's a battle that's gone on for decades, and it's going to be reheated, and we'll have it again going forward.
And do you think, this is another question from the audience, do you think that the surge in retail trading will have some effect on other issues like ESG, diversity, and so on that we're already seeing in corporations?
Yeah, I would guess so, because Robinhood goes with a sort of broad access to financial markets. And there's a lot of interest among a lot of small investors for investing in socially responsible firms and firms that are protecting the environment or being careful about the environment, and for firms with good governance. So I would not be surprised at all to see a lot more interest among retail investors in doing ESG investing, and that could have an influence on equity prices. Joe?
And it's not limited to retail investors. You know, some of the largest institutional investors in the world are really pounding the ESG drum. We can have a debate about whether they're doing it intelligently. We can have a debate about stock price effects or what have you. But it's clearly wrong to say ESG is the domain of the retail investor. You know, Larry Fink's letters on BlackRock, State Street's activities. There's a tremendous amount of evidence that the world's largest and most powerful institutional investors are very strongly picking up ESG themes.
And I also think some people want to understand shorting just a little bit more. And so there's two questions, one that has to do with Robinhood, one that has to do with the hedge funds who are shorting. As far as the hedge funds, people are wondering, why couldn't they have just held on to their short until the price went back down? And on the Robinhood, this is a different question, but why couldn't Robinhood just have raised their margin requirements to meet their capital needs?
Okay, let me start with the first one on why couldn't the hedge funds just keep their short position? Well, yeah, eventually the price will likely come back down, but in the meantime, it could get a lot higher. And the hedge funds were losing, I think you said, Anthony, $20 billion. At some point, they need to think about, do we have enough liquidity? Do we have enough capital? And even if we do, are we willing to wait long enough for that to happen? Will it take days, weeks, months, or years? So it becomes smart at some point to just get out of the way and take your losses.
So Darrell, let me typically when somebody shorts a stock, and if they wind up losing money on the short, won't the broker ask them to put up more money?
Absolutely. They have to post that margin on a daily basis.
So there you go. So there's a daily margin call. And at some point, you just don't have the money with which to put up the daily margin call. So one of the world's great traders I was in a meeting with once observed, just because something is inevitable doesn't mean that it's imminent. And just because it is inevitable that the price of GameStop would come down, that didn't mean that it's imminent. And if your broker is pounding on your door and saying, you've got to put up another $500 million in margin, and you've only got $600 million in the bank, all right, you're going to think about how much longer do I want to stay in this game, because even though eventually I will be right, and that's why understanding how much capital is backing a particular short position is really very important strategically to anybody who's trying to run a short squeeze.
Anthony, there was a second part of your question.
Yep.
Do you want to ask it again?
So the second part is different, doesn't have to do with the hedge funds specifically. This now has to do with Robinhood. And the question was, why didn't Robinhood just raise their margin requirements to come up with the capital?
Okay, so when the Robinhood raises the margin requirements, that money is their customers' money. It doesn't belong to Robinhood. And Robinhood is not allowed to use that money to meet its own capital requirements. So that's a pretty simple answer.
Yeah, but on the other hand, I would push back and I would say, let's have a look at the rules. If a customer has bought $1,000 worth of stock and the customer in effect pays for it with $1,000 on a real-time basis, why should the broker, whether it's Robinhood or anyone else, have any capital requirement against something that exposes it to no capital risk? Darrell, does that make sense?
Can you say that again, Joe? I didn't follow the logic. Go ahead.
Sure. The logic is, suppose I buy $1,000 worth of stock, and instead of my waiting 2 days to pay for it, I pay for it now, cash on the barrel. Well, at that point, the broker has no credit exposure to my transaction. So why should the broker have to post any additional collateral because I just bought $1,000 of a very risky stock?
My understanding, and you can correct me, is that even though you're not required to have more capital, in order to clear that trade 2 days later, the clearing corporation wants to see your money now, not just your customer's money.
And then the question I have is that rational? Is that optimal? Because you just need to have enough capital in order to close the transaction. And if the customer has already paid, you do.
Yeah, I guess you're right. If you could give the customer's money right away to the clearing corporation and say, this is no longer our problem. We don't need capital against this.
Right.
Yeah, I don't think it's currently done that way, but I don't see any reason it could not be done that way.
And that in a certain sense is the point, because it's my understanding that a lot of, and I could be wrong about this, that a lot of the trading that occurred at Robinhood was in effect fully collateralized. Let me make this go away. That was fully collateralized. So it didn't put Robinhood's books and records, at risk. It didn't put the system at risk. And yet Robinhood had to come up with a tremendous amount of capital to, in effect, guarantee the system against a risk that isn't there, which makes it even an all the more remarkable story.
And Joe, we're getting a question about SEC intervention based off of something that you said very early on in this conversation. Could you elaborate on what could have been some of the negative effects had the SEC decided to get involved and limit trading?
Oh, it's the classic effect that whenever you shut down trading in a market, you may in a certain sense be saving some people and helping other people, but at the same time, you're hurting other people. It's never a situation in which it's an unambiguous benefit. And every time you start talking about shutting down the markets, it's a very difficult conversation. I was in the middle of it in the 1987 stock market crash, if anybody can remember back that far. And I was arguing very strongly that we should not shut the markets down. The New York Stock Exchange was thinking of shutting down. NASDAQ was thinking of shutting down. And I was very strongly of the view that the worst thing in the world now is we can shut down, because if we shut a market down, it can't find its bottom and then start trading up. You're almost guaranteeing the worst possible result. And by shutting it down, you're signaling fear in terms of whether the market's going to be able to survive this. And at that time, there really was no fear about the market being able to clear and settle. All, as best we could tell, the plumbing was going to work. People just didn't like the prices. Well, hiding from something you don't like doesn't make it go away. All right? All experience suggests you had to trade through that and you would get through that. And that's exactly what happened. But experience also teaches that anytime a crisis like this comes up, there will always be a group of people who are running around saying, shut the market down, shut the market down, shut the market down. Unless you've got a different reason for shutting it down other than you don't like the prices, that's almost always a really bad idea that causes more problems than it solves.
I completely agree with Joe on that. The counterfactual is China in 2015 was experiencing extreme market instability, and the regulators just shut down the market. And every time they opened it, the price would drop dramatically. Then they would shut it again. What was happening was when they were shutting the market, no one was able to trade. They were very frightened and anxious to sell as soon as the market opened again. And as soon as the market opened, everyone assumed it was going to get shut again. So they traded some more and tried to get out of their positions. And the price just kept dropping. And that happened for months on end. And then finally, in January the next year, the regulators said, okay, we're not going to do that anymore. And things calmed down.
Darrell, earlier you mentioned that if perhaps a Reddit trader, a retail investor wants to learn a little bit more about investing, maybe they can come take some classes at the GSB. But clearly a lot of people who came here, they're really interested in investing. They want to understand what's been happening with the market. And we've received a couple of questions about where people can go if they want to learn more about the market and make intelligent investments. So Joe, they're not necessarily following, I forgot what you said, Angry Kitty on Reddit, or can make intelligent decisions on their own.
So my recommendation, if I had to state one source, would be a wonderful book called Corporate Finance by Jonathan Burke and Peter DiMarzo, which is the book we actually use here at Stanford Business School. And for anyone that's done, undergraduate Econ 50 or 101 or wherever it was at your school, that book is very accessible and it's extremely well crafted and easy to understand. And it covers all of the issues that Joe and I have discussed today, except the legal issues where you'd have to ask Joe to get his recommendations on that.
Another one, Random Walk Down Wall Street, right? Which in many ways is a wonderful argument for simple, stable, index-based investing, and explains why, on average and over time, taking advice from people like Angry Kitty is going to cost you as much as it's going to help you. You're not going to be able to beat the averages. And for the vast majority of the retail investors, a modest index strategy is the optimal strategy. And I understand people want to have fun, so taking a percentage of your portfolio, but limiting it, all right, and taking a flyer on, one thing because you like their product or another thing because you read a good article. Okay, fine, I get that. We can't be eating healthy all the time. I understand, not everything is going to be kale and carrots. So yeah, you can have, dessert, but limit it. All right, don't put all of your portfolio on the truck.
Yeah, I agree with Joe. And if someone finds that they want to express their views by trading equities and they don't really have an investment motive, well, I would not be one to say you're not allowed to do that, as long as you're doing it eyes open and you know that you're taking risks. But I do think, coming back to everything we've said today, those that oversee the market and those that intermediate the market need to be prepared for that going forward.
Yeah, I'll put another one. If you want to take a small percentage of your portfolio and invest in a way that makes a political statement that you think is valuable to you and you understand it's likely to cost you money, go right ahead. Don't put your whole retirement fund in it, though, please. Personally, I'm asking you, don't do that.
And so we're coming to the end of our time right now. And there have been a couple questions about Elon Musk that I want to cover at the very end. Some attendees are wondering, how can he keep tweeting about different stocks? It seems like whenever he tweets something, the stock price shoots up for weeks afterwards. How is it legal that he can keep doing this?
That's a question for Joe.
Oh, Darrell, go ahead. You take a shot at it.
I have no idea.
No, okay, I'm happy to do it. So the first question is he expressing an opinion? Is he telling a lie? Does he own the underlying stock? Is there anything else going on? If Mr. Musk is simply expressing an honest opinion about something, and he doesn't own any stock, right, that he's talking about, and that's his view, God bless America. All right, he can do that. That's not misrepresentation. That's not an omission. He can express any opinion he wants about anything, all right, especially if he doesn't also have a financial interest involved in it. But that's too simple a life for Elon Musk. All right, Elon skates closer to the edge and likes more complexity. So apparently, not only has he been saying favorable things about Bitcoin, but it now turns out that Tesla holds $1.5 billion in Bitcoin and is going to start accepting Bitcoin, all right, as payment for Tesla, subject to certain conditions, and who knows. So if Musk had no position in Bitcoin, then his statements about Bitcoin, everybody's talking about Bitcoin, fine, not a problem. But now that we know that Tesla has 1.5 billion exposure in Bitcoin, and he's been saying things that arguably increase the value of Bitcoin, he's given the SEC a regulatory hook to investigate his statements about Bitcoin. The SEC has said Bitcoin's not a security, so they as a practical matter, would have no reason to get involved. But the SEC, but Bitcoin is now something that shows up on the financial statements of Tesla. Musk is a control person of Tesla. He arguably has been saying things that increase the value of an asset held by Tesla. And this is going to give the SEC jurisdiction to look into it. And I'd be surprised if they haven't been doing that already. So Elon has just given the SEC an open door to look into pricing of Bitcoin.
That's really interesting.
Yes.
And and we are just at the end of our time. And I want to let all of our attendees know, thank you so much for coming today. We have so many questions, more than we could get to, so I apologize if I wasn't able to ask your question to Joe and Darrell. I wish we could stay on for a couple more hours to cover every single one of them. But before we wrap up, do you have any last thoughts on this matter, Joe and Darrell, that you'd like to share with our audience?
Anthony, I just want to say it was a pleasure to speak with you and Joe. It seems like every time there's some sort of a car wreck in the financial markets, Joe and I get the band together again and talk about what are the implications. And this is definitely another signal event in financial markets that I don't recall having seen anything like before, but I suspect we're going to be talking about again. Thank you.
Look, it's just such a joy to have colleagues like Darrell at Stanford and students like Tony. It's really a blessing. And one final thought: you can go to the moon, but you can't live there. And whenever people wind up doing these trades, manipulations, whatever you want to call them, please keep your wits about you and recognize it's not going to end well for lots and lots of people.
Okay, thank you so much, Joe and Darrell, and everyone. Thank you so much for attending. We really appreciate it. And Joe and Darrell, we appreciate all of your insights.
Yeah, thank you,
Anthony.